Madame Georgieva, thank you for joining us. There's a lot of talk about some of the debt suspension actually getting an extension. When should we start worrying about the amount of debt that we're generating and the impact it will have on the economy longer term?
First, thank you for having me. The worries about debt levels going up are not for now. For now, the biggest worry is that we don't do enough to support the economy until we have a durable exit from the health crisis. With interest rates being record low, governments can borrow and inject, hopefully, not only a recovery, but a more potent, higher productivity-based growth so they can repay the debt they are acquiring now. This is, however, not the case for low-income countries already in debt distress. And this is why it is so important that we make sure they are provided with relief and they are supported with grants and concessional financing, a big theme for our annual meetings.
But what is the biggest risk to your outlook right now? I know you say the recovery is going to be uneven, but you've actually increased your projection somewhat.
Well, the situation today is less dire than it was a couple of months ago, but dire nonetheless. We are projecting minus 4.4%. And as we all know, the big problem we face is that we are not out of the woods of the pandemic yet. And until that happens, until we have this durable exit, we have to be concerned whether there is sufficient support for firms and for workers so we don't hit a wall of massive bankruptcies and a massive increase in unemployment. This is short-term my biggest worry. Longer term, we are very concerned about the scarring this crisis is bringing. There are sectors of the economy that are very severely impacted. Low-skilled workers, women, young people, they are hit hardest. And how we make sure that inequality doesn't expand dramatically as a result of this crisis, with the digital economy and those who can work there doing really well and the rest of the economy doing poorly. That requires sound policy thinking and making right now to prevent this scarring.
If we don't have a COVID-19 vaccine in 2021, will it be another lost year for the world economy?
If we don't have a vaccine, but we sustain support at the level that we have had it during 2020, there will be recovery, but this recovery is not going to be as potent as we need it to be. So what do we project for next year? Slightly over 5% growth. This is not going to bring us to the pre-pandemic, to the 2019 level. And in fact, we are projecting that by 2025, we will have lost 28 trillion as a result of this change in trajectory because of the pandemic. So uneven, uncertain recovery that is not enough to bring the vibrancy in our economy until we get vaccines or treatment, so we can exit the crisis.
Your forecasts in the World Economic Outlook are on the premise that actually there will be a peaceful transition of power, as far as I understand, post-U.S. election. Are you confident that's what will happen?
We are confident that the United States has fiscal space and has a very well-defined monetary policy. And we saw it in these previous months. It worked really well for the U.S. This is why we are seeing an improvement in our projections for the U.S. economy, with a very positive spillover on the rest of the world. We see this policy continuation to be, in any case, something that fortunately, the U.S. can afford.
But what happens if there's not a peaceful transition of power, if President Trump were to lose and not want to give up?
As you said, it is not in our baseline scenario. And certainly we do project different scenarios, but this is not in our baseline scenario.
MD, are you worried at all about the resilience of banks in this COVID era?
Well, what we see is quite remarkable. We were hit by a financial crisis, and then we regulated our way out of risks that were the reason we got in this crisis to begin with. The financial system is strong and sound. We have stress tested it, and it looks like we are in a good place. However, there are two things to worry about. The first one is that parts of the financial system, the non-banking financial institutions, they're not as regulated, they're not as supervised, and there is tail risk associated with them. We assess this risk to be some $220 billion. And two, we cannot take financial stability for granted. In other words, if we are to not retain our eyes focused on the real economy, that we don't allow bankruptcies to hit us like a fast-moving train. If we are careful about it, then we can be relatively comfortable about financial stability. And this is why my message, Francine, I'm sure you hear it, your listeners hear it loud and clear. Do not withdraw support prematurely.
MD, are we too optimistic on the growth outlook for China because they are an exporting country and so really depend on how the rest of the world are doing?
What we see is a recovery in China that surprised us on the upside. Driven by two things. One, successful containment of the pandemic, and two, a primarily manufacturing-driven growth in the economy. Our message is for the next year, for the year after, we see manufacturing recovering much faster than services, and if we don't have a vaccine, contact-dependent part of the economy is going to suffer. So in China, indeed, manufacturing recovered, their exports recovered. The positive for the world is that demand from China for commodities has gone up, which has boosted commodity prices. Many countries, commodity exporters, have a breathing space as a result. But the service part of the economy is still weaker in China, and this is what is still holding full recovery. We project for next year growth in China to be 8.8%. This is quite significant, and it would help China, but it would help also Asia and the rest of the world.